Right, good morning, everybody, and welcome to WHEB's second quarter webinar. So just in terms of the format this morning, I'm going to be joined in a moment by T. Lee, who's going to go through the strategy review and the outlook for this quarter. And then following that, Seb Beloe is going to join us, and he's going to talk through some of the outcomes from this year's impact report, which we launched about a month ago. And take you through some of the key highlights from that report. So without further ado, then I'm going to hand over now to T, who's going to take us through the strategy review and the outlook. Thank you.
Thank you, George. Hi, everyone. Thank you for joining us today. I'm T, an associate fund manager on the investment team. This morning, I'm going to review our fund's performance for the second quarter, discuss the market condition, and provide our outlook for the strategy. To start with the market condition, we have been discussing how interest rate expectations have dominated the equity market for more than a year now. Although interest rates expectations remain the key theme in news headlines during the quarter, there's a noticeable decoupling between the US stock market and interest rate expectations. Despite the low expectation for interest rate cuts during the quarter, it had a minimal impact on the US stock market. The strong performance from AI-exposed stocks helped drive this divergence, which I'll come on to later. Better economic data, including strong employment data and better than expected earnings, were also the drivers for the US stock market. In Europe, the European Central Bank decided to cut its interest rate after making some progress in controlling inflation. As stock markets are always ahead of actual events, the European stock market fell following the rate cut after the ECB warned of downside risk to economic growth over the medium term. We believe interest rate will be less of a driving force going forward, and the equity markets will be more driven by the underlying economic fundamentals, which will be favorable for our strategy. There were a few market factors which explained our relative performance during the quarter. The first one was a strong performance from Magnificent Seven, which consists of big tech and semiconductor companies. They continue to dominate the US market this quarter, driven by the hype of AI. The standout was the stellar performance of NVIDIA. Its remarkable growth has recently propelled it to become one of the world's most valuable companies. NVIDIA gains has been particularly influential in the broader market. It alone accounts for a third of S&P 500's gain this year. As a reminder, except for Tesla, we do not consider any of these companies impactful because their AI applications are not specific enough to establish the theory of change. However, not owning any of these companies in the strategy has led to a meaningful negative impact on our performance relative to our benchmark. Another market factor was the challenges that we observed in sustainable investing. Global investors sold a net $40 billion in sustainable equity funds over the in the first 5 months of this year. And this trend marked a stark reversal from the sector's previous meteoric rise. And these outflows led to selling pressure in our sectors, and some of them are now oversold. We observed that ESG premium has disappeared in some of the stocks, presenting value opportunities for us. In addition, the ESG movements faces issues of greenwashing and political backlash, particularly in the US. Large corporations, including Unilever, Bank of America, and Shell, have cut or have missed or reduced their emission reduction targets in the past year. To counteract all these, transparency and disclosure are very important to support sustainable investing. And that's why we have been committed to publishing our impact report for the last decade that Seb will talk more later on. The last market factor in the is the near-term challenges in the EV market. Our strategy does have quite a meaningful exposure to the EV market through various parts of the value chain. While countries like China, India, and France continue to see healthy growth, others, such as Germany, Italy, and the US, face significant challenges. Some automakers have cut their EV targets, citing high production costs and regulatory uncertainties. As a result, Bloomberg has expected EV sales to grow at a slower pace through 2027 compared to the previous expectation, but still a healthy annual growth of 21%. The EV transition has now entered a fiercely competitive phase. A number of EV manufacturers have filed for bankruptcy this year. On the positive side, consumers now have more affordable EV options. In the US, at least like 3 manufacturers, Tesla, Hyundai, Kia, and General Motors, now offer several 300-mile range EVs, which cost less than the average new car in the US, as you can see on the chart on the right-hand side. In China, EVs are already cheaper than traditional ICE cars. In addition, the geopolitical landscape is adding complexity to the EV market. Both the US and EU have started imposing heavy tariffs on Chinese electric vehicles in this quarter, sparking speculation that the Chinese government may retaliate. As we know, protectionism is detrimental for decarbonization. While we believe the EV market will continue to grow, the road ahead appears to be bumpy in the near to medium term. Now turning to our thematic and fund performance. Our strategies lag behind our benchmark MSCI World during the quarter. As you can see, we performed roughly in line in the first 2 months, despite the headwinds from our health exposure and our style bias towards mid-cap stocks. And both respective indices underperformed during the quarter. Clean energy was also a drag on our performance, and it was very volatile during the quarter, which I will discuss more later. This is what we are legally required to show you our long-term performance relative to our benchmarks. As you probably know, we do not manage our strategy against the benchmark, and our investment universe only has 15% overlap with the MSCI World. Our focus is on the performance contribution to return, as shown in the next slide. From the theme perspective, water management was the best contributor, followed by sustainable transport, despite the challenges in the EV market we just discussed. On the negative side, resource efficiency theme was the worst contributor, followed by our health theme. Our life sciences holdings, including Agilent and Thermo Fisher, both were weak due to the worsening outlook in the pharmaceutical market and in China. In the next couple of slides, I'm going to explain what drove these thematic developments. On the positive side, water management emerged as the best contributing theme this quarter. A number of our holdings in this theme have benefited by offering innovative solutions to pressing sustainability challenges. One of the best contributors in this theme was Xylem. Xylem is a water technology company offering water and wastewater treatment solutions. A significant development this quarter was the establishment of the first ever national drinking water standards for PFAS by the US EPA in April. Many countries worldwide are also tightening regulation for PFAS or on PFAS monitoring and treatment. Xylem is really well positioned to address these new regulations with this really broad PFAS portfolio, helping communities and industries to meet stringent water quality standards. Another standout contributor was Ecolab in the theme. Ecolab offers a wide range of water management solutions, including advanced water treatment and purification technologies, helping its customers to optimize water usage and improve efficiency. It benefits from its customers' increasing focus on trying to achieve both business outcomes and positive environmental impact, as you can see on the right-hand side. And its products are designed to help enhance operational efficiency while reducing environmental footprints. And this dual focus on both business and environmental outcomes has made Ecolab a preferred partner for many companies looking to achieve their own sustainability goals. On the negative side, resource efficiency was the worst contributor this quarter. First, the global manufacturing economy remains sluggish throughout the period. while there's some signs of recovery in industrial production in the US, the landscape in Europe was mixed. Chinese manufacturing was continued to contract over the last 2 months. Traditional industries like automotives and heavy machineries continue to experience slower recoveries due to the ongoing disruptions in global supply chain and varying demand. Another significant factor affecting our resource efficiency theme was the weakness in the semiconductor sector. Despite the rush of AI sales, the semiconductor companies face excess inventory problem. Semiconductor companies in the S&P 500, excluding NVIDIA, reported falling sales in the first quarter of this year. Inventory level rose to $53 billion at the end of the first quarter, almost twice the level at the end of 2019. And this inventory overhang has impacted prices and profitability, contributing to the weakness of some of the semiconductor companies in the near term. We believe semiconductor plays a crucial role in energy transition, which makes it a vital part of our strategy despite the short-term headwinds. Turning to our individual stock contributors, First Solar was the standout positive contributor both from the theme and sector perspectives. As you can see, the other holdings in the same theme, including Nextracker, Vestas, and SolarEdge, all contributed negatively during the period. Schneider Electric was another positive contributor. On the negative side, the bottom two contributors, Silicon Labs and Daifuku, were both from our resource efficiency theme. And the underperformance was driven by different reasons, which I will cover in the next few slides. Starting from the positive side, First Solar was the best contributor this quarter. As a leader in solar energy technology, First Solar has uniquely positioned itself in the US solar market, particularly in the utility scale segment. And this strategic focus has been instrumental in its exceptional performance. A significant trend observed this quarter was the stark contrast between the residential and utility solar markets. While the residential solar market was challenged by the cost of living crisis and high interest rates, the utility market, where First Solar excels, has remained resilient. First Solar's outperformance was due to its strategic alignment with the US Inflation Reduction Act, which provides substantial incentives for local manufacturing and renewable energy projects. With this significant capacity for local manufacturing, First Solar is really well positioned to capitalize on these incentives, expected to drive much higher margins in the coming years, as you can see in the chart on the right-hand side. While there has been lots of speculation of what will happen to the US Inflation Reduction Act if Trump becomes the next president, we believe the risk of repealing the IRA is low, particularly in relation to the tax credits for the solar sector. And this is because both the red states and blue states have benefited huge investments in renewable energy projects due to the tax credits from the IRA. And this act has created and will continue to create a lot of job opportunities for the solar sector. And that's why we believe the chance that Trump will repeal the tax credit for the solar sector is low. Schneider Electric was another standout contributor this quarter. Is a leading solutions provider in energy management and industrial automation. While industrial automations was a bit challenged the last quarter, energy management continued to perform well, as you can see on the chart on the left-hand side, and is mainly driven by very strong demand from data centers and grid infrastructure. We have very strong conviction in the company because it's really well positioned to benefit from a number of secular trends, including digitalization, automation, and electrification. And it also holds a market-leading position in several end markets benefiting from sustainability growth drivers. And here we list two sustainability trends: the accelerated growth of electrification in industrial setting and the increasing number of connected devices. And both trends have been driving strong demand for its electrical and automation products. The company is also poised to benefit from the growth of electric vehicles, heat pumps, and battery storage over the long term. On the negative side, Silicon Labs was the worst contributor. It specializes in Internet of Things technologies, the semiconductor chips that help to connect all devices in smart homes and automated factories. The recent underperformance was primarily driven by the weakness in the semiconductor sector that we just talked about. The company is still going through the destocking process, which explains why the recent quarterly sales was way below its historical average. The company also cut its quarterly guidance, suggesting a more moderate recovery trajectory. On the other hand, all the trends have been improving for a number of weeks, suggesting that the last quarter was the trough of the cycle. The company also continued to see design wins, validating its competitive position in the markets. It also has a long-term track record of consistently outperforming the end markets with its proprietary technologies, which gives us a confidence that growth will return once the market demand rebounds. Daifuku was another negative contributor this quarter. Its products support the automation of warehousing and manufacturing, helping to reduce energy and resource use in these activities. We witnessed a sharp reversal of its share price performance in this quarter, almost eliminating most of its gains from the first quarter. Although the company delivered solid results with strong orders, the share price underperformed the local market. And it's mainly because one of its major customers, Amazon, decided to handle some of its maintenance work in-house in the US instead of rather than outsourcing to Daifuku. The company also guided for lower than expected margins for its intralogistics segment due to the impact of low margin projects in the US. During the quarter, the company unveiled its 4-year business plan. Although the sales growth target for the next 4 years was a bit lower than what it delivered previously, 7% is still a decent growth for considering that most of its end markets or some of its end markets are having a really tough time right now. The company also guides for margin expansion over time through improving efficiency and introducing new technologies. But there are short-term headwinds in some end markets. The chronic labor shortage and rising labor costs should continue to drive the business over the long term. Now let's move on to talk about the outlook for our strategy. In the short term, we can categorize some of the sectors that we invest in 3 buckets: challenging, recovering, and positive momentum. Starting from the challenging bucket, the EV market is expected to take a while to adjust to the weaker weaker demand in the near term. The rapid growth in previous years and the changes in the subsidies in some countries have led to a supply and demand imbalance, and the market will need some time to stabilize before resuming its growth trajectory. In the recovering bucket, we are seeing some promising signs in a couple of sectors. In our health-themed, destocking in bioprocessing have been a very strong headwind, but orders for bioprocessing are now improving. Some companies have seen more stabilized inventory, which suggests we support recovery in the sector. However, sales of life sciences equipment and the Chinese market may still take a while to recover. So overall, we are cautiously optimistic about our life sciences holdings. Similarly, the semiconductor industry is still digesting excess inventory. However, there are some green shoots in some specific areas, such as smartphones, suggesting potential for recovery. Market expectations for the sector have also been reset after several companies have cut their full-year guidance. Lastly, in the positive momentum bucket, we are very optimistic about electrification, which continues to gain traction. Many utilities have committed to investing in grid upgrades and expansion. This drives demand for transmission and distribution systems, which bodes well for our investments in this space. In addition, the environmental consulting industry is seeing more opportunities driven by the US Inflation Reduction Act and the EU Green Deal. And this regulatory framework provides a very favorable environment for growth and innovation in environmental services. The recent EU election have reshaped the political landscape with significant gains for right-wing parties. And this shift raised concerns about the future of sustainability initiatives, including the EU Green Deal, which has been a cornerstone of Europe's environmental policy. Their increased influence could lead to a more fragmented approach to climate policy. This could potentially slow down the implementation of new green initiatives and affect the allocation in future budget cycles. However, there are reasons for optimism. Centrist and left-leaning parties still hold a significant majority. And this group remain committed to advancing environmental policies and sustainability goals. The recent UK and French election results also suggested that voters have not given up on climate action. Obviously, we will be watching closely the US election in November. Also, market-driven demand for sustainable solutions remains strong, driven by consumer preferences and economic benefits. Our strategy always tries to minimize regulatory risk where possible and prefer investing in companies whose solutions provide both economic and environmental or social benefits. In the last couple of slides, I would like to discuss the challenges and opportunities arising from the rapid growth of artificial intelligence. The exponential growth of AI investments has led to a significant surge in energy consumption. Data centers today are already use more electricity than most countries, with only 16 nations consuming more. According to Bloomberg, by 2034, total energy consumption by data centers is expected to top about 1.6 petawatt hour, which is equivalent to India's entire energy usage. And this growth is driving a heightened demand for renewable energy sources and other sustainable solutions. Renewable energy is playing a very crucial role in providing the necessary energy infrastructure to overcome this challenge. For example, First Solar expect data center could account for as much as 40 to 50% of utility scale solar market, up from 20% today. As shown in the chart on the right-hand side, major technology companies are already significant buyers of renewable energy. However, there has been criticism that these companies are still not doing enough to meet their own climate targets, with Microsoft reporting a 30% increase in greenhouse gas emissions since 2020, and Google a 67% increase. AI also presents investment opportunities for us beyond the energy sector. As you can see on this slide, our holdings in the portfolio are already deploying AI solutions in their respective industries. In industrial settings, AI enhances operational efficiency and safety. Keyence in our portfolio provides automated inspections, which help optimize processes across manufacturing and logistics. In grid infrastructure, AI is a game changer for microgrid management. It allows precise control of electrical demand and supply, facilitating seamless integration with renewable energy and reducing reliance on traditional grids. In buildings, AI transforms how we manage energy consumption, from optimizing HVAC systems to enhancing electrical load management and building automation. Moreover, AI reshapes infrastructure development by enabling data-driven decisions such as predictive maintenance, which help improve resilience and efficiency. In transportation, companies like Aptiv pioneer autonomous vehicle technologies, which could potentially help improve safety, reduce traffic congestions, and lower emissions through optimized driving patterns. As impact investors, we are only interested in investing in very specific AI applications which have direct sustainability impacts. As with any other technology, AI brings both opportunities and challenges. On the positive side, AI helps improve efficiency, reduce costs, and promote sustainability. However, challenges like data privacy and ethical considerations require careful navigation. With that, I'm going to hand over to Seb to talk about our impact report. Thank you.
So yes, as T mentioned, we have been publishing impact reports now for 10 years, and this is our latest one. We're very proud of our reporting. We've won a lot of awards for it, and we do think that it really sets the standard of what impact managers, and perhaps all managers, should be disclosing in terms of their exposure to sustainability. We cover a whole range of different aspects of our performance. We focus in particular, of course, on impact, but we do also cover the ESG profile of the strategy and provide more and more reporting actually on stewardship and engagement as well. And we like to think that it's pretty candid as well, that you see both the positives and also some of the areas that we need to improve on. So I would encourage you to take a look at the report. It's obviously available from our website. But I will just go through some of the headlines and some of the key things, some of the key messages as well. One of the things that we've spent quite a bit of time on in the report is preparing for the requirements of the sustainability disclosure, the SDR regime, sustainability disclosure requirements. It's been quite a process for us going through that process with the FCA, and in fact we are still going through it. One of the things that they have, I think, helpfully done for us is to provide some constructive challenge on the clarity and the specificity of our sustainability objective. In the past, we've talked about our strategy being focused on investing in companies that provide solutions to sustainability challenges. The FCA have encouraged us to be more specific about what that means. And in the draft prospectus that we're currently discussing with them, we do talk about these two areas in particular, so supporting a stable climate and healthy ecosystems and enabling more productive and healthy lives. And actually the prospectus is even a lot more detailed than that. But hopefully that's giving a little bit more clarity about what it is that we're trying to achieve with the strategy. And then the other thing that is worth emphasizing as well, which is something that we introduced a few years ago with our white paper on impact investing, is this point about our impact being composed of these two elements. There's the impact that's associated with the companies that we invest in, the assets that we invest in, and the impact that they deliver. And then separately, there's the impact that we can have ourselves through our engagement and stewardship activities. And really our reporting is structured around those two elements. The other bit that is very prominent in the SDR, particularly for the sustainability impact label, is this need to disclose and describe the theory of change that you have that governs your approach. In the past, we've done a lot of work at the level of each individual investment that we make and understanding the theory of change that exists there. So how does the particular product or service that the company sells, how does that actually deliver impact in the real world? But the FCA are keen to see this described at the level of the strategy as a whole. And this chart is intended to capture that. It's in the impact report as well. I won't go through all the details, but at a high level, essentially what we're trying to do here is describe the theory of change, which ends up with those outcomes or the objectives that we've set for the strategy as a whole on the right-hand side. And essentially what we do, going through from left to right, is we've identified a set of problems, social and environmental problems that we're seeking to try and help solve. We've identified then parts of the market that provide solutions to those problems and categorized those into our investment themes. We then have different tools that we've developed to analyze those potential opportunities, both from the perspective of the impact that they deliver, the overall quality of the operations of the company, including the ESG quality, and then also, of course, areas like valuation and portfolio construction. Our levers of change are then obviously investing in the company, most obviously, the stewardship and engagement that we do both with the companies themselves and also with the system, so that's with policymakers and standard setters. We obviously have the opportunity to divest as well as a lever of change. And then we talk about signaling as well. How we report and disclose this activity as a way of trying to influence the rest of the market. And then ultimately, this ends up with these indicators that we measure in terms of the impact of the investments that we make, in terms of the assets themselves, and then also our activity in terms of stewardship engagement, and trying to identify outcomes that we can link with our engagement. So that's the overall theory of change that we've described in the report, and I'm also putting forward to the FCA for SDR. I want to spend the rest of my time now just talking about performance and what we can see in terms of some of the data that we're reporting. So most obviously, this is on the impact that we're delivering through the investments that we make. This has been a big part of our reporting and also of our impact calculator that's available on our website. Strictly speaking, this isn't our impact. This is the impact that's associated with the companies that we invest in. And we've provided 2 years of data. We have actually been collecting data, as many of you will know, for many years, 7 years now of impact data that we've collected. But for the last 2 years, we've been using data from a third party, and so which is really a reasonable basis on which to compare performance for those 2 years, rather than going back 7 years, which would include data that we collected ourselves. And this data does come with a caveat. It's only 2 years, and the data is bouncing around a bit still, so it's not mature. Nonetheless, you can see some trends, and in this case, with these 3 core environmental impact indicators, you can see an improvement year on year. The y-axis does vary across the different metrics, so sometimes it's rather more modest than it appears, but nonetheless an improvement in each case. Avoided emissions, that's the impact of businesses in our resource efficiency theme in particular, where they're, for example, selling technologies that allow manufacturers to be more efficient in their use of energy. It would include also businesses in our sustainable transport theme that are supporting battery electric vehicles, and you see a reduction in emissions with a battery electric vehicle compared to an internal combustion engine vehicle. So that's what that is measuring. Renewable energy is really just about renewable energy, solar and wind power in particular, and the amount of renewable energy that's generated associated with our level of investment in those companies. Waste recycled is principally plastic waste being recycled into stormwater systems, and recycled cardboard as well is a big focus area for us. So you can see how that's all improved year on year. Another theme for us is water management. We actually measure 2 aspects of water management. One is around wastewater, and the other is around water saved. So that's efficiency technologies focused on water, particularly in manufacturing. And this is measured in megalitres, which is millions of litres. And all of this, by the way, is per £1 million invested in the strategy. So it's normalized around £1 million. The wastewater numbers have bounced around quite significantly, and that's an example of this maturing that I talked about. The reasons for this more than trebling of positive impact in our wastewater indicator is because of an acquisition that one of our companies made in 2022 that boosted their exposure to wastewater treatment. And then another business which called Veralto, which had previously been part of another company that we own called Danaher, T mentioned. It was spun out last year and now is reporting its own data separately, which it hadn't done before. So that's better quality data that's really driving that change rather than necessarily an underlying change. So yeah, some caution in terms of the data. And then finally on the social side, a bit more mixed performance here. Healthier lives and well-being comes from companies, for example, that make safety technologies, helping keep people safe. We also include this year vaccines in this category. So vaccines used obviously to keep people healthy, prevent them from contracting disease. Previously, that's been in the healthcare category, and we've moved it into well-being. And that explains that some of the changes between those two different categories. The decline in health in terms of number of people treated is also partly because of COVID, where we still saw some some numbers of people being treated with diagnostic kits, for example, in 2022, and that really tailed off completely in 2023. And then finally on education, that's really the decline in performance in that indicator is really due to the sale of one of our holdings in the education theme in 2022. So I hope that gives you some sense of really, I think, a good message really in terms of improved performance in many of these indicators, and we'll obviously keep reporting this year on year going forward. We also cover a lot of ESG data, so this is more about the operations of the companies that we invest in rather than the impact of their products and services. And here too, the story is being pretty good. We've taken an example of gender diversity. The data goes back 7 years in this case, so a much more solid data set. And this is measuring the proportion of women in senior management and board level positions at companies. And you can see that this has improved quite significantly over that 7-year period, from 17% of boards and senior management teams being made up of women in 2017, and that's increased to 27% in 2023. So a significant increase over what is still a relatively short period of time. We are behind the benchmark on this measure. That's really due to the fact that we tend to invest in sectors and industries that have historically had poor gender diversity, and not in parts of the economy like media and entertainment, which tend to have quite high levels of gender diversity. But you can see that over that period, actually our companies are diversifying in terms of gender more quickly than the market. And obviously that's really good news, and we're very proud to have been a small part in supporting that change. On the carbon side as well, I'll just give you two more. On the carbon side, we measure our performance here in two ways. We measure the proportion of the emissions coming from the portfolio that are covered by net zero carbon commitments. And you can see here in the chart in the middle that in 2019, that was essentially zero. I think we had one company actually that had a net zero carbon commitment. And you can see how quickly that has changed over the years. That's the rate of change has slowed down in the last couple of years, but we now have 82% of the emissions from our portfolio are now covered by net zero carbon commitments. That was up from 80% last year. Our target is to have 85% of the portfolio covered by net zero carbon targets in 2025, and then the full portfolio 100% covered by 2028. That's that dotted line. And then on the right-hand side, this is the actual performance in terms of actual emissions. And you can see there a few things to call out. That grey line is measures our financed emissions. So these are a measure of the scope 1 and 2 emissions that we own through our holdings in these different businesses. And you can see that fell very dramatically in 2021. That was due to the sale of a company called China Everbright Environment Group, which is a waste to energy operator in China. We sold that partly for concerns about their strategy on climate change. And that has meant that our financed emissions are 89% below where they were in 2019. So well ahead of our target, which is for an 18% reduction. The other number that's important is that darker line, and that measures the emissions that are associated with companies that were in the portfolio in 2019 and remain in the portfolio today. You won't get that data point from almost any other asset managers. So we are extremely transparent about this. And that number has fell in line with our targets through 2020 and 2021. Sadly, that was mostly due to COVID, and that has now bounced back to roughly where it was in 2019. It has the rate of increase has slowed down in the last year. Obviously, we don't have that many data points. And our hope and expectation really is that the commitments that the companies have made will increasingly flatten that curve, and then we'll see a decline in the years ahead. But that's trying to measure the ongoing emissions of companies that are held in the portfolio across that period, whereas the financed emissions takes into account buys and sells as well. And then finally, before we open the floor to questions, we spend a lot of time on our stewardship and engagement work, and of course disclose all the data around the activities of our engagement, so the letters that we write, the meetings that we vote at, all those activity metrics. But we think it's really important to try and focus also on the outcomes that we're trying to achieve with our engagement. The point of engagement isn't just to do engagement, it's to deliver an outcome. And so what we're trying to show here for our work on greenhouse gas emissions is the changes that we're seeing in terms of outcomes and aligning that with the work that we're doing on engagement. So this chart shows you absolute emissions on the y-axis, which is a logarithmic scale. And then on the x-axis, it's showing you the degree to which the company's strategy is aligned with the Paris Agreement, from not committed to aligned. And the two data points are from last year to this year. And you can see that there has been some very modest changes around emissions, sometimes increases, sometimes decreases, and more substantial changes in terms of strategy. Now, we don't claim that these changes are solely due to us. That would be ridiculous. But we do believe that we're making a contribution here. We are asking for these things from these companies, and they are increasingly delivering them. And as I say, we think we're making a contribution to that change. So this is one way of trying to focus attention, not just on the activity of engagement, but also what it's delivering in the real world. And you can expect more of this kind of reporting from us in the future. So I hope that's been helpful, and I think we have time for a few questions. So I will stop sharing my screen. Thank you.
Great, many thanks, Seb. Thanks for that. T, if you want to come back onto the screen, we've now got a little bit of time for questions there. Just to come straight back to you, Seb, as it's a question that's come through on the impact report. Good to see the improvements in the data year on year in the impact report, but how reliable is that data that you report, and what happens if you can't get the data? Is it audited data?
Well, yes, I slightly, in terms of the quality of the data, it is improving year on year. We've still got a way to go, I would say. In fact, in the impact report this year, we published an interview with 5 companies in the portfolio, talking to them about their reporting of impact data. And it's clear that the methodologies can certainly be improved. But I think our shift to using a third party is a sort of indicator of the maturing of this as a discipline. Because we are using the third party who has consistent methodologies, we think it is more legitimate to show year-on-year comparisons. Where companies don't report data, the third party, which is called Net Purpose, by the way, they will develop models. So they will use models that estimate impact data associated with revenue numbers and things like that. So there is still some level of estimation there, but they're pretty robust methodologies that they're using to do that. So I would say, it's much improved, and we can expect it to improve more, but it's robust enough to use as a data set now.
Great, thanks for that, Seb. So T, a question for you. About the sort of valuation of the performance of the portfolio at the moment, the earnings growth we're forecasting for the next 12 months, and sort of aligned with that, sort of, are we capturing any value opportunities, given that we've seen a sort of a very challenging period for ESG funds generally? We've seen sort of froth come out of the market. So where do we see the sort of investment opportunities that come from that, and the value opportunities that come from that?
Yeah, so in terms of the valuation for the portfolio, is probably around 25 times PE. And in terms of the earnings growth, most of the holdings in our portfolios is expected to grow to deliver around low double-digit kind of mid-teen growth, but it's more kind of longer-term growth rather than just next 12 months. I think it's really important to emphasize that when we look at the valuation, we are also looking at the absolute level, because we also need to consider the quality of the earnings that the company deliver. And we are also looking at the next 12-month earnings growth. We are looking for the next 3 to 5 years earnings growth as well, because a lot of our companies are really benefiting from more kind of long-term sustainability growth drivers rather than just next year earnings. In terms of capturing the kind of the valuation opportunities that I kind of talked about earlier, I think I can give you one example that we just recently initiated a position in American Water Works, which is a US water utility company. Just to give you a bit of context, like all these US water utility companies used to trade at a much higher valuation because there is basically scarcity of water stocks in the US and there are lots of water funds. So there's always a premium in these kind of companies. And what we have seen is all this kind of ESG premium has now basically disappeared. When we talk to the company management, they basically admit that like in 2020, the ESG premium is pretty too high and the only way is coming down. And what we have seen now is the valuation has really come down to a much more reasonable level. And that's why we think it's really an interesting entry point. Maybe just as a sign for the UK investor who is really worried about the water utility, the impact of water utilities, we do see very clear differences between the US regulatory environment and the UK regulatory environment. In the US, definitely there are much more attractive returns to incentivize water utilities to invest in infrastructure, to accelerate infrastructure investment, to improve resiliency, reduce kind of water leakage, and improve the water quality as well. And there's also various mechanisms to incentivize utilities to recoup their returns in a much faster way. Whereas in the UK, most of the utilities are basically leveraging up to pay out dividends.
Great. Thank you, T, for that. Just a couple of questions around benchmarks. One saying that I understand that MSCI is not a helpful comparator for performance because your funds are different. Can you say more about how the funds perform against this universe and peer group? And also, just whilst we're on the topic, are your allocations to regions and market cap bands driven solely by stock picking, or do you have any constraints on the maximum deviation relative to benchmarks?
Sorry, yeah, so yes, it's actually a very good question, because when we look at our performance relative to our universe, which is we have outperformed our investment universe over the last year. So really a lot of the headwinds on a relative basis really driven by the Magnificent Seven and the kind of mid-caps headwinds. When we look at our performance relative to our peers, we've very much performed roughly in line over the last year, but we also outperformed some of them over the longer term. So it's really much a kind of sector-wide headwinds for the whole impact space, due to the kind of the style bias and the sector exposure, because impact funds tend to invest more kind of in the mid-cap space and more kind of focusing on the growth and quality spaces. And this has been very challenging in this high interest rate environment. In terms of the allocation in relation to regions and market cap, yes, so we do have this kind of geographic neutrality principle, which basically we try to mirror our kind of customized benchmark, which consists of MSCI World, MSCI Mid-Cap, and our investment universe. So our geographic allocation will be very similar to these composite benchmarks. We try not to deviate hugely from this geographic allocation. We don't have a very kind of clear kind of guideline in terms of market cap band. So it's mostly kind of driven by the bottom-up idea generation in terms of the market cap. Yeah. But certainly we always keep an eye on the in terms of the concentration in kind of different style and market cap band as well.
Yeah, and I guess that's very much an output rather than an input, if you like. So we kind of the focus on impact companies, the natural expression of that means that we find ourselves in mid cap, and actually the opportunity set of our universe doesn't look a million miles away from that kind of banding of the MSCI World Mid Cap or the MSCI World Index. The MSCI World Index, the US weighting has been really driven up by those Magnificent Seven. So by using our universe and the Mid Cap Index as a kind of waypoint for the sort of geographic dispersion of the fund means that we keep it fairly balanced on that side, and it's a kind of a natural expression of where the opportunity set is. And just whilst we're on the subject of having US exposure and regional exposure, well, Seb or Ted, Seb or T, you could answer this. I'm sure maybe I'll put it to Seb in terms of given the US exposure, we touched on Trump and the Inflation Reduction Act. what do we think? What do we think about the challenges of a potential Trump presidency come next year?
Yes, I mean, I think he touched on this a little bit in terms of his comments around the Inflation Reduction Act, which certainly in terms of the insights we get from our experts that we have in the US, pretty much consensus on that being fairly resilient, not least because a lot of these jobs are created in so-called red states, and there are plenty of politicians who would certainly not want to see the IRA be repealed. It's also interesting, by the way, I think it's worth addressing this wider point about populism, perhaps as well, taking hold in Europe. There was a very interesting piece that actually was published by Shell in their Shell scenarios, talking about the extent to which there are populous states where renewables are doing incredibly well. Hungary is one rather unexpected example of that. Viktor Orban is a big supporter because of the domestic kind of benefit that they get from renewable development. Poland also, and in the US, Texas has just, I think, is overtaking California as the largest generator of solar power in the US. So I think it's a misreading of the politics and of Trump in particular that this is always going to be bad news for renewables. They've become so much a part of the infrastructure now that it's not driven just by concerns about climate change. There are big benefits in terms of jobs and economic impact as well. Nonetheless, I mean, Trump's natural appetite to accelerate change is pretty limited. If you look at the forecasts around emissions coming from the US, with both presidents, you're seeing, both candidates, whoever the Democratic candidate ends up being, you're seeing significant declines in greenhouse gas emissions. Of course, the issue is that decline isn't fast enough to achieve 1.5 degrees. And our sense is that a Democratic candidate is more likely to want to try and accelerate that. But I don't think there's any real concern that there'll be a dramatic pulling back from what's already planned. It's also worth just stating, last time Trump was elected, it was on the basis of he's going to save coal. That's absolutely dead in the water now. No one is saving coal. So the trajectory is very clear. It's just the pace at which we progress.
Great, thanks, Seb. And whilst we're talking about emissions, there was a question. I think you somewhat answered this in the presentation, but just to recap, do you have a strategy in engaging with companies to decrease emissions? Maybe that's the new part of the way. But and can you report and claim progress on that? Right?
Well, yes, and that was my final slide was really around this idea that the point of engagement isn't engagement. That's not the point. The point is to try and deliver outcomes. And so that table that I showed was showing you the outcomes that are taking place in terms of improved strategies around climate change and ultimately reducing emissions. That is fundamentally what we're looking for. And we can correlate the work that we're doing with those outcomes. We are extremely nervous around claiming any level of causality because honestly, it's absurd to claim causality. These are very large companies. They have loads of investors talking to them about these issues. They have loads of their customers talking to them about these issues. To try and say that it's us that's changed that perspective is clearly nonsensical, but we do claim that we contribute. And I think that's all you can claim really as an investor.
Yeah, great. And I don't know whether it's a good idea or not to finish on SDR, but the question is SDR going to change our investment process or the way we report impacts? Clearly, currently being in the weeds of it at the moment, we don't want to jinx it, but can you make some comments there, Seb?
Yes, I mean, again, I think I mentioned this right at the start of my presentation, but SDR won't change our investment process. It's what it is changing a little bit is how we talk about it, how we present it, and so as I said, there has certainly been a helpful challenge from the FCA in terms of clarity. And one of the things that we hear from other peers who are going through this process is the importance of having clarity from your objective right through to the indicators that you're reporting. How do the indicators demonstrate that you're meeting your objective? We think that's very helpful. That's a sort of maturing of our sector. But yeah, we're not going to be changing anything about the investment process, which we think is absolutely consistent and aligned with what the FCA is looking for.
Yeah, and I think it's worth saying, I mean, clearly there's a lot written about SDR right at the moment, because a lot of people are right in the sort of focal point of sort of going through the process. And as the process is at this stage is leading to a kind of definition of the market to some extent. So there's it's unsurprising in a way that it's quite convoluted, or it's challenging to get from the sort of previous state to hopefully where we get to a point which will make it ultimately, by design, much clearer for consumers and much clearer as to what funds are trying to achieve. And that's all something that we hugely welcome. But it's sometimes difficult to see when you're right in the weeds of that process of rewriting practices and the like. So I just had a bleep, which I hope means it doesn't mean that we're out of time, but we want to thank everybody very much for joining us today and being on this call. We'll go through the questions. If there are any we haven't answered, we'll follow up individually with people. But thank you all for attending. Thank you for your support, and we'll look forward to seeing you next time. Thank you.